PrairieSky Royalty is increasing its dividend by 2%. TD calls this company, which collects cash from oil and gas companies operating on acreage in its portfolio, an asset base, quote, that replenishes itself or grows, with nearly $2 billion worth of capital spent on its lands in 2025. We are joined by the president and CEO, Andrew Phillips. Andrew, thanks very much for coming on the show.
Good afternoon. Thanks for having me, Andrew.
Just give us a breakdown, roughly, if you can, between oil and natural gas production on your lands, please, in percentage terms.
Yeah, oil and liquids make up about 63% of our production by volume. The remainder is natural gas, but that oil and liquids portfolio generates about 93% of our revenue right now, just given the weak gas pricing.
And I know at least one analyst was encouraged to see that your liquids or your oil and liquids production were up lately.
Yeah, we've actually had almost 4 years now of consecutive organic liquids growth. So it's been a big positive, just given some of the capital efficiencies of the great producers on our lands. We've been fortunate to see them continue to grow, and therefore we continue to grow.
Maybe we'll put up a 5-year chart for the U.S., the Henry Hub natural gas contract. Your pricing, though, for natural gas is mostly off AECO, the Alberta contract?
It is, yeah. So we get paid 45% AECO monthly, 45% daily, and then 10% of our gas goes through SUMAS. So for the most part, we collect our royalties on the AECO pricing and the AECO benchmark, which has been subdued over the last few years.
That's frustrating, isn't it? We keep hearing talk about massive natural gas demand to fuel electricity generation, but prices still depressed.
Yeah, it's been a challenging sector for sure for the last 5 years. 2022 was a bright spot for sure. I think we have some of the best producers in North America operating in our basin and some of the lowest cost gas resources. So ultimately, we will find a way to get better value for our gas and get the molecules to market.
And quite a bit of your acreage in the Duvernay formation?
Correct, yeah. Some of our fastest growing acreage is in what we call the West Shale Duvernay. There was a significant discovery made there over the last few years, and it's been expanded to the point where now it's starting to get to full development mode. So that's been a bright spot for us from a production standpoint.
Just looking at your stock over 5 years, you have lagged XEG, the energy producing ETF. Now, obviously, you can say, well, you know, we sink in zero capital. We're more predictable that way. We don't run that particular risk. But why would you have lagged over 5 years?
Yeah, it's a good question. I think ultimately, just given we have 98% operating margins, zero capital costs, and a strong return profile to shareholders, I think it should ultimately do better than the XEG, as most of the mining royalty companies outperform the bullion over time. So I think in the fullness of time, we should outperform those, but there's definitely more operational leverage on some of those names that are within the XEG, which kind of pulls them up a little bit in sometimes when people are looking for exposure. But I think over the long term, we should be able to outperform that, I would believe. And
of course, that XEG is dominated by the giant oil sands stocks that have really won the hearts of investors lately.
Correct. Yeah. And those are wonderful businesses. They're long duration businesses with low declines, and they make up the biggest part of that index. And they're very, very good companies. So we're fortunate to have them in our country, and we're fortunate to have a few of them as large royalty payers.
Your payout ratio is something like 70%. Would you increase it, or why wouldn't you go to nearly 100% if you have zero capital cost?
Yeah, we can take a lot of the free cash flow and invest in the business. We believe the intrinsic value is somewhere in the range of $50 to $60 per share for our business. So we believe we're buying dollars for 50 cents when we cancel shares. We canceled 2.6% of the shares outstanding last year. We're also able to do $100 million of M&A in the mid-teens last year. So with that kind of return profile, some of the capital creates a better business if you can redeploy it in those two ways.
Sorry, you've been buying back stock. And what was the other thing, buying land or buying rights to land?
Yeah, there are certain royalty packages available. We bought a $50 million package last year that was the Petro-Canada fee that dates way back to the early 1900s. And that's an asset that we think we can achieve mid-teens or higher return at $57 crude. So a great opportunity to redeploy some capital in high return projects. That's always our preference if they're available. But because we own over 70% of Canada's fee, those opportunities are less and less.
And can you remind me, have you gone into the States at all? Have you looked at buying acreage down there or buying rights down there?
No, we stick exclusively to Canada. We're the largest in Canada, and I think we do look at the U.S. auctions and some of the where some of those royalties trade, and they seem to for less high quality assets, they seem to trade to lower discount rates. So we just find Canada's what we know, and that's what we understand. So we just stick to our knitting.
Andrew, we better jump. Thank you very much indeed for joining us.
Appreciate having me.
Andrew Phillips, President and CEO at PrairieSky Royalty.